economist and quantitative analyst at Prescient Investment Management, Hannah Nobrega, speaks to us now to expand on the CPI reading. Thank you so much for your time. An ease in CPI, Hannah, is more than welcome, but it's not nearly enough to result in an interest rate cut. So let's talk about the implications when it comes to monetary policy.
Thank you so much for having me today. You're quite right. The ease that we've seen in inflation hasn't been enough yet. We haven't reached the midpoint yet. We've only gone to 5.3%, and we actually want to come right back down to 4.5%. However, we are on our long-term downward cycle of inflation, so we can expect cuts relatively soon, let's say after the first half of this year. We just want to compare inflation quickly as to why we did have a little spike of inflation last month versus February. You'll notice that the February inflation was 5.3% as well, and then the March inflation was 5.6%, which was a bit of an upward surprise to most people. However, that was solely attributed to administrative prices, which is a survey that is only taken biannually, so twice a year. And those prices have now dissipated fully in the economy, allowing inflation to come back down to its downward trend of 5.3%. We may expect a slight increase of inflation maybe in the next 2 months. This could be attributed to a little bump in the fuel prices. This is an exogenous shock or an external shock from the turbulence and the geopolitical turbulence that we're seeing in the Middle East. And then also, if the El Nino cycle persists a little longer, we're expecting a few dry weather conditions, which might keep food prices elevated, even though the food price inflation has come down quite a lot, which is something we'd like to see.
You mentioned a little while ago, Hannah, that the desired rate for the Reserve Bank, of course, would be within the target range of 3 to 6%, but much lower. Are we then saying, given the trajectory that you've alluded to of inflation in the near term, having a pace that is gradual in the decline to a lower level of inflation, as opposed to an accelerated level of CPI dropping at fundamental levels where we are able to basically say that the Reserve Bank can confidently start cutting rates by the end of this year, as the likes of the US have already indicated?
Yes, so if you consider the SARB's forecasts for growth, inflation, even some exchange rate forecasts, then we see that the economy is behaving in a way that is very responsive to monetary policy. The markets have also priced in interest rate cuts that are in line with what the South African Reserve Bank has communicated in the last MPC. Today, this morning, the market pricing for interest rates was a little bit there was a bit of turmoil because of fear just before the CPI print came out. So the markets were pricing in that there might be interest rate cuts only at the end of 2025, and that was also maybe some fear from the US's speech last night. But we can definitely expect, with all the moving parts of the economy coming together, we can definitely expect inflation and interest rates to start coming down at the end of 2024.
What would that mean for an ordinary South African, given that while there is an ease in inflation, it would give a little bit of relief, particularly on the side of food and non-alcoholic beverages, not so much transport, because the petrol price is set for another increase come next month, but on the side of the repo rate remaining at elevated levels and consumers remaining under pressure still. It is almost 2 years of this elevated level of interest rates, which have proven to be quite a burden on the household expenditure.
Yes, so a flat line in food prices will at least, the consumers will feel a little bit at ease, and we can comfortably purchase. The demand has been flattened out quite comfortably, so there isn't inflationary pressure on demand side anymore. So if the consumer is reacting in a way that allows inflation to also settle down a little bit further. That'll help inflation come down, at least from the demand side. And then from the supply side, there would be some inflationary pressure there, obviously from fuel prices they might have a pass-through effect into your goods and services, and we see it namely in services. As soon as those pressures start to ease off, then we can start thinking about rate cuts, and then the consumer will feel a lot less pressured soon after that. So I think the flatlining now is quite important for the consumer, so we're not under an upside pressure anymore. People can comfortably know that most people are getting at least wage increases that are at least keeping up with CPI, so they can comfortably ease into that. And then when inflation comes down and doesn't just flatline anymore, then the pressure will be off completely, and hopefully consumers won't overconsume thereafter by creating another demand pressure. So the interest rate cuts shouldn't be too large, so that we don't get another upside surprise from demand.
A balancing act, economist and quantitative analyst at Prescient Investment Management, Hannah Nobrega, speaking to us about the latest inflation print. It has put consumer price inflation in South Africa back down to 5.3%.